All, I'm Hemant. I'm the founder and CEO of INRI. I'm extremely excited to be presenting this webinar with my co-host and panel, Karishma Himnani, who's an enrolled agent, and Dinesh Reddy, who's a tax expert. Both are in the US and have been working with us for the past 2-3 months. Some of you who would know, we launched tax US tax filing this season, and we had an amazing response. We'll share more on how that went, but more importantly, what we realized that a lot of people that worked with us and we kind of consulted both on filing and then looking into the future. People do a lot of mistakes when it comes to planning their taxes. And it is not a one-time thing, but something which has to be done year round and for many years to come as scenarios and situations changes. And so are excited to be presenting an aftermath of how this tax season went and what we learned ourselves, and want to share this with the broader audience. Before getting there, I just want to share about INRI. We started in March 2023. That's what the time we got the funding from Y Combinator, and then we began our journey. It's been 2 years, and I'm excited to be building this so far, and adding more products and verticals, and more importantly, users. So we have crossed more than 12,000 users today. And in terms of products, we offer mutual fund investments that are in India. But in addition to that, we've also expanded now to offering alternative assets classes in India, and will soon be starting even in the US. In terms of a new vertical, we started with tax and compliance, and we've already launched US tax filing, and something we'll be launching very soon is India tax filing. So, and I'm personally also excited for 2025 because we are in the process, in the pipeline to offer more products that are designed for the users, as we have heard from them in terms of what they're looking for, what are the problems that they face, and we'll be offering them very soon. So with that, Dinesh, please take over, help us understand, and Karishma, how we could save more on taxes.
Thank you, Hemant. I'll take it forward from here. Firstly, thank you all for taking time out on a weekend to attend this webinar. I'll start with a quick introduction. I'm Karishma, a tax manager from New Jersey. I have over 12 years of US tax experience working with Deloitte and PwC. I spent a major part of my career in global mobility taxation, helping people traveling to or from the US manage their tax filing requirement. Being in a new country, it's easy to overlook the intricacies of the US tax system, and that can lead to surprising tax bills or missed deductions and even penalties in some cases. So, through this webinar, we want to spread awareness about how smart tax planning can make a significant difference. We'll walk you through the common mistakes like the misreporting of RSU cost basis, under withholding, and help you take advantage of the powerful strategies. And first, before getting into that, let's start with the 2024 tax filing statistics. We served over 1,000 clients this tax season, which was a milestone we set out to achieve. And thanks to your trust and support, we did it. As we look ahead, our mission is to reach even more Indians across the US and make tax filing smoother, simpler, and stress free for all. The next stat we want to share is the average IRS penalty and the balance due. Uh, Approximately, the taxpayers pay around $850 in penalties, and the balance that they settle along with their tax return is a little over $13,000. The reason for this underpayment and related penalty is due to under withholding on the W2 income. And if they have significant investment income and they've not made any quarterly tax payments, then that also results in penalties and underpayment of taxes during filing. Over 50% of the clients were affected by this, and we are going to deep dive into how you can minimize these penalties and the balance due when filing the tax return. The next stat we wanted to share was itemizing. around 10% of our clients were able to itemize deductions, while the rest use standard deduction. Many taxpayers assume they can itemize to reduce their tax bills, and the reality is that most don't qualify. One common misconception that we noticed was people thought if they donate to charity or pay mortgage interest, they can itemize to lower the taxes. The reality is you can only itemize if your overall eligible deductions exceed the standard deduction, which is 14,600 for single filers and 29,200 for married filing jointly. So if you contributed $1,000 to a charity or donated $2,000 worth of items to Goodwill, and these are your only deductions throughout the year, you don't get a benefit for these donations since the standard deduction is a lot higher, which is available to all. So through our tax planning, we try to help people understand how they can maximize their contributions through the year uh, in order to itemize, or if it's better for them to just stay on standard deduction. The next statistics is that only 2% of the clients claimed energy efficient home credits and 5% claimed the electric vehicle credit. If you're interested in learning more about these opportunities and their eligibility requirements, feel free to drop a comment in the chat and we'd be happy to host a dedicated webinar to walk you through them. The last statistics is that we noticed 1 in 4 clients had a multi-state filing requirement, often due to relocating during the year or traveling for work. When reviewing their prior year tax returns, we noticed that they missed to pick the credit for the other state tax paid on their resident return. So if you have 2 or more state filing requirements, please review your tax return to ensure you're not paying double tax on the same income that is taxed in different states. Moving on from the statistics, let's dive into our first real world case study. This is especially relatable for salaried individuals, particularly those working in tech or large firms. In this case study, the client has a W-2 salary of $180,000, which includes vested RSUs, 300 shares granted at a fair market value of $180 each. Later, they sell those RSUs at $220, resulting in a capital gain. Outside their W-2, they also have other capital gains and dividend income. And their overall W-2 withholding during the year was $28,000. We'll walk through where the tax issues arise and how small oversights like underreporting the basis or missing the payments can lead to major surprises. The first issue in this situation is misreporting of RSUs. You all may be aware that RSUs are taxed as ordinary income at vesting based on the fair market value. Brokers often report a $0 cost basis on the 1099B, which can cause misreporting and often leads to double taxation, which means that you're paying capital gains tax on income that was already taxed as compensation in your W-2. And this is something we noticed a lot of people reporting, misreporting on the prior year returns, which we tried to correct through their filings this year. Now, the best way to avoid this error is to check the broker's supplemental info to report the correct cost basis and avoid overpaying. Let's walk through an example to understand how RSU cost basis misreporting can lead to a tax bill. So Aman had 300 Apple RSUs vest in 2023 at a fair market value of $180. That's $54,000 of ordinary income, and it's already included in his W-2. So he has paid around $17,000 in federal tax on it. Now, here's where the issue begins. When you sell the shares, let's say in 2024 at $220, your broker's 1099B might show a $0 cost basis, which is incorrect because your actual cost basis is $54,000. If you report the sale using the correct basis and your capital gain is just $12,000, taxed at 15%, your capital gain tax would be $1,800. But if you don't adjust the 1099B and report it with a $0 basis, the IRS sees a 66,000 gain and you'll owe 9,900 in capital gains tax on income that you already paid tax on. That's an additional tax of $8,000, which is completely avoidable just by using the broker's supplemental tax information and reporting the correct basis on your return. So this is one of the most common RSU filing errors we see, and it's an easy fix once you know what you are looking for. Now that we've seen how misreporting RSUs can lead to double taxation, let's take it one step further. Even when RSUs are reported correctly, the way you time the sell can make a huge difference. This brings us to the preferential tax rates and how holding your investments just a little longer can unlock significant tax savings. First, qualifying income like long-term capital gains and qualified dividends are taxed at lower rates, typically 15% for most people compared to ordinary income, which is taxed at twice the rate, 32% or maybe even higher, depending on which tax bracket you fall under. To benefit from these rates, the timing is key. You need to hold your assets for over 12 months and a day for capital gains to qualify as long term. For dividends to qualify, the stock must be held for at least 60 days around the ex dividend date. Now, let's look at how this impacts RSU. Uh, if you sell the RSUs immediately after they vest, any gain is taxed at ordinary rate and you get no benefit. So in this example, a $12,000 capital gain would be taxed at $3,840 had Aman sold it immediately upon vesting, but the tax bill would only be $1,800 if we held it for long term, which is over 1 year. That's straight $2,000 in tax saving. Similarly, the 7,000 of dividends, other dividends that he had, if they were ordinary, then that would be taxed at around $2,240, but only $1,000 if they were qualified dividends, which means he had to hold it for just 60 days longer than his current holding, and that would give him additional savings of $1,200. So put together, that's over $3,200 in tax saving just by timing your sale. Now, next, this is a slide where we've summarized at what income level the preferential rates change from 0% to 15% to 20%. You can keep this slide handy for future reference. Now, so far, we've looked at how proper reporting and timing around RSUs and investments can reduce your tax bill. But tax savings don't stop there. One of the most powerful and consistent strategies in maximizing your tax saving is your pre-tax contributions. Let's talk about your 401k and HSAs, which is available to all. And these are two tools that not only help you save for retirement and healthcare, but also reduce your taxable income today. So, say you're contributing the full $23,000 to your 401k and 4,150 to your HSA if you're single. That can reduce your gross income by over $27,000. And at a 32% of marginal tax rate, that translates into a savings of $8,700. And this money is going directly into your future and not to the IRS. The HSAs is one of the most powerful tax saving tools because it offers a triple benefit. Your contributions are tax deductible, reducing your taxable income. The growth is tax free, meaning any interest or investment gains are not taxed. And then the withdrawals are tax free if you use them for qualified medical expenses. So whoever has the benefit of contributing to the HSA, they should ideally do it year on year. Now, in addition to saving your regular income tax, your pre-tax contributions can help lower your exposure to net investment income tax. This is a strategy that many high earners overlook. It's a lesser known tax that can sneak into your tax bill if you're a high income earner. It's a 3.8% surtax that applies to investment income. Investment income like interest, dividends, and capital gains. Once your overall income crosses the threshold of $200,000 for single filers, and $250,000 if you are married filing jointly. So let's move on to an example to see how it works. The 3.8% applies to the lesser of your net investment income or the amount your income exceeds the threshold. So in this example, Aman earns $180,000 in salary plus 12,000 from RSU gains, other capital gains, and dividend income. So in total, his modified adjusted gross income is $235,000. That puts him $35,000 above the net investment income tax threshold, and he ends up paying $1,330 in NIIT. But by contributing to his 401k and HSA, his modified adjusted gross income drops to $200,750, and that is just $7,850 over the threshold. So the reduced NIIT base results in the additional surtax of 3.8% by just $298. That is saving him over $1,000 in NIIT. So on the next slide is a quick summary of this example showing how the power of tax advantage contribution does not just reduce your regular income tax, but also your net investment income tax. Now we are all, while on this topic of tax planning, here's another common trap that we see, which is under withholding. Your RSUs, which are taxed at vesting, the default withholding rate is often 22%. But your actual tax rate could be 32%, which means you're under withheld by at least 10% on just your W-2 income. And here we are not even considering your other investment income, which covers your capital gains, dividends, or interest. Now that mismatch combined with the mismatch of under withholding on your W-2 and your investment income usually results in a big tax bill at filing. And this is what we observed in most of the INRI customers who ended up paying at least $13,000 to $15,000 in taxes in April. Now, in Aman's case, the underpayment was around $15,000. Dinesh, if you move on to the next slide, we'll see that example and how this is calculated. So this explains in detail how the underpayment was arrived at. Now, the IRS safe harbor rules say that you must pay at least 90% of your current year's liability or 110% of last year's tax liability if you earn more than $150,000 to avoid penalties. Aman only had $28,000 withheld. So he'll likely face a penalty around $750 depending on when he booked his investment gains, because his actual federal tax was $47,000. Now, if we bring together all of this in a single slide, doing a recap of the client profile, which was a very relatable case for many professionals in the US working in major companies like Apple, Tesla, Amazon, or Meta, who get these RSUs. He earned $180,000 in salary, receiving 300 RSUs, sold them for a capital gain, and had other investment income as well. Like many, his federal tax withheld was only $28,000, but without proper planning, that would have fallen short and triggered the penalty of $750. By engaging in proactive tax planning, here's how we helped Aman reduce his total tax liability. By correctly reporting his RSU basis, we saved him a tax of around $8,000. By timing the sale and getting the benefit of preferential capital gains rate, he saved another $9,000 in tax. His qualified dividends taxed at 15% against the ordinary rate of 32% saved him $1,200 in taxes. By contributing to the tax deferral contributions of 401k and HSA saved him another $8,700 in tax. And this also reduced his net investment income tax by $1,000. He avoided underpayment penalty by constantly being on top of his investment profile throughout the year. And his total tax saving was $28,720. So this simple, just your W-2, your RSU, and investment income has a lot of tax saving potential, which a lot of people overlook during the year. Now, this was one example where we spoke about a salaried employee. Next, I'll hand it over to Dinesh to walk you through a self-employed individual and how there is tax saving potential in their scenario as well.
So thank you, Karishma. So we also got opportunity to work with startup founders, startup employees, and solopreneurs who are mostly doing either a contract job or gig economy job and getting paid as a contractor or as a self-employed individual. So in this scenario, we have Rahul who works as a startup founder and who also had 500,000 RSAs, restricted stock awards. People also get incentive stock options or non-qualified options, where during the time of the grant, the share strike price or fair market value is $0.01. So we helped Rahul to file an 83B election with the IRS. 83B election is supposed to be filed after 30 days of the grant, within the 30 days of the grant, so that in case in future when the stocks get vested to you and the strike price went to $5 or $10, you would not be paying tax on the actual strike price. Instead, you would be paying tax on the fair market value during the exercise period. And the spouse also earns $270,000 as a contractor. They have a primary house where in California, the mortgage interest is very high, and they're ending up paying $32,000 mortgage interest and around $18,000 in property taxes. We also advise them about the charitable donations and how they could utilize in the tax return by itemizing their tax return. And they're filing joint. And we gave them three tax strategies. The first strategy is 83B election, where they filed within the 30 days of the grant and they save $10,000 plus in future taxes, which is every year the stocks gets vested. And if after the 1 year, if the strike price or the fair market value of the stock is going up, then they are saving the taxes in advance. And we also advise the spouse, she has the income of around $270,000, and we advised her to contribute $63,500 into solo 401k. So directly, she saved $22,000 in taxes, which includes federal, state, and self-employment taxes. Using itemization on Schedule A, we help them increase their itemized income to $42,000 versus a standard deduction of $29,200, which resulted in $4,500 in excess deductions. So overall, they were able to save $36,500 in taxes by using an 83B election and managing the income by contributing to a solo 401k, understanding how itemizations work and standard deductions work, and increasing their itemizations. There are also other credits that most of the people overlook. These are some basic things like what Karishma was mentioning about HSA or mega backdoor Roth to save your taxes in the future on 401k. If your 401k account is growing big and you are nearing the retirement, or in the next 15-20 years you have retirement plan, then learning mega backdoor Roth will also be a useful tool, which most of the clients are already doing, and there is a room for many more people. And sometimes dependent care credit is overlooked, either by the tax company that prepares their tax return, or even the clients are not aware that they could claim the dependent care expenses and not pay tax on the dependent care expenses that they're spending on their children. And energy credits is slowly picking up, but there is still a room for a lot of people to take advantage of energy efficiency upgrades in the home or making an EV purchases. So these are the overlooked credits. Back to you, Hemant, Karishma.
Yes, thank you, Dinesh, for walking us through the self-employed scenario as well. Now, moving on, since you all have seen that there is a tax benefit or tax strategy planning involved both for salaried individuals as well as self-employed individuals, INRI is offering a free tax planning session, which is an initial 30-minute call where if we'll assess your 1040 or prior your 1040 to see if there are any deductions or credits or planning opportunities that you may have missed, and then work with you to see how the future tax year 2025 might look for you, and if there is any tax planning advantage that you could utilize. Now, we are offering this only for the first 25 spots. So once this webinar is done, Hemant will send out the form for you to complete. And once you show your interest, we'll share links with you on how you can book these free consultations.
Yeah, thank you, Karishma and Dinesh. I think this was a great presentation, covering multiple scenarios and then going over actual real examples where one could relate to, as a customer or in the audience. Um, yeah, I want to emphasize on this. I think we are excited to be bringing this free tax planning session. This is a 30-minute consultation to cover your scenarios, understand, what's your tax profile is like, and then suggest solutions that can help you save money for the coming year and even further ahead. I am sharing this Google Form link on the Zoom chat. Feel free to use this to fill it up. Following that, we will reach out to you and help you set up a call with one of our tax experts who can guide you on your tax situation. And please note that this is on a limited basis, so we are only taking 25 free consultations to begin with, and there is also a deadline that we're trying to put up, so it will be May 15th. So make sure to sign up before that to claim this free session with one of our tax experts. So next is a Q&A. So we have some questions all I see on the Zoom chat. So we could begin answering that.
Yes, Hemant. So the first question is around how the tax liability is calculated and if they book the profit majorly in December. So to understand this clearly, are you referring to the underpayment penalty?
Yes, underpayment penalty.
Okay, so the underpayment is penalty is calculated on a quarterly basis. So if you sold your investment, say in December, then the underpayment penalty will only apply to the last quarter. And so the quarterly dates are April 15th, June 15th, September 15th, and then Jan 15th. So you will still have some underpayment penalty if you're not paid in, say, at least 110% of prior year or 90% of current year tax. And also this calculation of when you have sold the investment, that needs to be shown on Form 2210, where you annualize the income for the year.
Got it. Thank you.
No problem. And then next question is around the 401k contribution limit. Does this 23,000 apply only to employee contributions or also employer? This 23,000 limit is only for the employee contributions. The actual limit for 401k is $69,000, which is a combined for employee and employer match. And that's how there is this solo 401k, which this single member LLCs or the sole entrepreneurs can utilize, where they can contribute the employee and employer match for their respective plan up to 69,000.
Okay, next question is by Soham. Let's see.
That was the question for 401ks.
Okay, sorry. The next one is then. Okay, I think Vineet mentioned to me. So, what are tax reduction strategies outside of what you discussed here for W2 high income earners? So, particularly around W2 and who are earning a higher income.
So there are several tax strategies available. The ones that we just discussed, were only based on what we saw in the current year filings through this platform. Now, there are several, it depends on each person to person what strategy applies to them. There is no one plan fits all. That's not available, and that's the reason we are offering this free consultation, to see what benefit you could get from by looking at your prior year tax return.
Okay, I think that's the set of questions we have so far. Any feel free to ask any questions. We're happy to answer right now. Anything, Dinesh, you wanna add? Okay, there's one question now. What's the tax savings when buying a home versus renting?
So one common thing that we observe when buying a home versus renting is that for rental, there are a few states which give you the deduction for rent paid. New Jersey is one of those states where you get a benefit of up to 18% of the rent that you pay in a year, up to $15,000. Not all states give that benefit. And as far as buying a home is concerned, then you get a mortgage interest deduction as part of itemized deductions. Now, again, that depends on what your mortgage is. Like we initially mentioned, it only if your overall deductions for the year exceed $29,200 if you're filing jointly, or $14,600 if you're filing single, then the mortgage that you pay could be beneficial.
Yeah, I think like couple of you, which is what is 457B? What are you referring to, Manadeep?
So, Dinesh, my employer was telling me that we don't do 401k here, and we do 457B. And they were advising me to go with 457B, and I had no clue. So,
457B is deferred compensation, Manadeep, and I'm not sure like why do they want to defer your compensation? Is it helping you from the tax angle? Go ahead, Karishma, saying something.
So 457B is another form of retirement contribution in line with the 401k. It depends on what plan your company has registered for. So you can discuss with them what the benefits are, like why are they not offering 401k and 457B? What's their benefit and what's your benefit in it as well. But it serves the same way as far as 401k is concerned. So you get the same pre-tax deduction against your W2 income.
okay, got it.
Hi, Karishma. Can I ask, am I audible?
Sure.
So generally, I mean, my spouse is not working yet, but she's trying to get a job. But generally, is it, from a tax perspective, is it a wise idea to have her join a company as a W-2 or a 1099 contractor so that, we can reap some tax benefit, based on this setup? Is there any general advice on that?
So when you say
I'm a W-2. I'm a W-2. But if she is it good for her to join as a W-2 employee or a 1099 contractor so that overall it works out on a tax favorable?
So there are pros and cons to both situations. So if I have to quickly highlight to you, as a 1099 contractor, you get to claim few expenses which are not available for W2 employees. But at the same time, W2 employees get few perks and benefits which you may not be eligible for as a 1099 contractor, say your HSA plans or any other benefits that every firm has their own benefits. So As far as tax filing is concerned, you get to claim expenses as a 1099 contractor, which you do not get to claim as a W-2 employee. But you also need to know that there is a self-employment tax, the Social Security, the FICA, Medicare that gets deducted on your W-2. As a 1099 contractor, you are liable to pay both the employer and employee portion. So the Social Security and Medicare tax, which is say 7.45%, which includes your 6.2 Social Security and 1.45 of Medicare, you will have to end up paying 15.3% as a 1099, which is 7.45 for employee part as well as employer part.
Okay. 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 So there are pros and cons. Okay. Okay. But the tax saving vehicles like either 401k or solo 401k, is there any difference on their maximum contribution limits based on these vehicles? Like, is there any difference? Like, you said about.
Contribution limits stay the same for both. It's just that as a 1099, you can contribute the employer portion also. Like, Manideep or someone else initially mentioned there was a 7% employer match in the firm. As a 1099 contractor, you can do a 100% match also. Say you're contributing 23,000 and then as an employer, you contribute another 23,000 to that plan. So you can get the maximum benefit in that case.
Okay. But either way, when it comes to combining both the tax, both myself and my wife's taxes, the married filing jointly or separately, those options are always available, right? Either if it is a W-2 or 1099.
Correct.
Okay. Thank you.
One second, I'm just going through the questions here.
So there's a question which was asked to me directly. I put up in the chat. Did you see any tax returns where real estate investing was used to reduce W-2 taxes, and how?
So we didn't see any tax returns which involved reducing W-2 taxes using real estate, because real estate income is considered to be a passive income. If you are having any loss from real estate, also it would be considered a passive loss. And to offset it with the W-2 income, you will have to qualify as an active real estate investor. So we have done consultations with a couple of investors who are active real estate investors and helped them offset their W-2 income. But in the regular W-2 employees, we haven't seen any. Karishma, did you get a chance to see any who offsetted W-2 with a rental loss?
It's that, only if you are an active participant, you get
Yes.
to
Yeah.
reduce your income against the expenses. Now that's again, you have to work with someone to see whether you are eligible to be an active participant or not. If you do not meet those hours required to show material participation or active involvement, then that investment property becomes passive and that cannot set off your W-2 income. The next question is on W8, that if you receive 1099 dividends or interest instead of 1042S, what are the options and recommendations? Can you elaborate on this question, please, Dhaval? So I wanted to, okay, that's okay. If you want, you can just separately, we can connect separately to understand your question, because I would like to know your residency rule status, whether you are a non-resident, a resident, why are you receiving a W-8? And so you are a non-resident and you are on you were on W8, as in you filed W8 Ben to show the exemption from withholdings. Dinesh, do you want to do you think you can
No, I
address
haven't.
based on this limited information? We might need more information from you, Dhaval, so we can discuss and then guide you accordingly.
So Manadip, married filing separately, married filing jointly, it's just the tax slabs are different. Rest of the credits more or less apply the same. Usually married filing joint is the preferred. Why do people file separately? Is if they separate, then they file separately. There are some experts who advise to file separately to save some on taxes, but based on my experience, if you do simulations also, it will be more or less the same. Karishma, you want to answer the first question on the separate
Yeah.
joint? Anything else?
So I see sometimes people say both but if you're both of you are filing unless there is a significant benefit, again, there's an optimization calculation that we perform if the taxpayer says to us that they would like to know what the benefits are for filing jointly versus separately. And in that optimization calculation, we can see if filing separately is really giving you a benefit or not. More often than not, filing jointly is preferred. And as far as credits are concerned, few of the credits are not available when you're filing separately, like your child tax credit. It's only available if you file jointly. So it's person to person, and it really depends on your specific tax situation. There is no straightforward answer as to which filing status is beneficial for you or not.
Got it.
The second question, Manadeep, you asked about buying a house. So is it for a primary house or a rental house?
Primary house.
Yeah, if you take a primary house, then you can deduct mortgage interest paid on the primary house up to $750,000. So if you're purchasing a house for $1 million or more than $1 million also, still you would be able to deduct interest on your tax return up to $750,000. So your mortgage interest plus your state and local taxes that can be capped at $10,000. Plus, if you are doing any donations, cash and non-cash, three of those numbers can be clubbed as your itemized deductions versus standard deduction of $29,000 approximate. Uh, so you are able to increase your like itemizations, thus decrease your taxable income.
Got it. So as a follow-up, so you can only claim up to $10,000
In state and local taxes.
state and local taxes, including interest, or interest is additional to that?
Interest is separate. Mortgage
Oh.
interest up to 750K is separate.
Oh, so when you say 750K, is it the home value of 750K or is the in loan value of 750K?
Loan value.
Oh, loan value. For the, let's say I'm buying a $1 million house. So for the another 20, I mean, the remaining $250,000, I still pay taxes on that, right?
Yeah, the mortgage interest. So you
Got
will
it.
be able to claim the mortgage interest.
Mortgage interest on that.
Yeah.
Got it. Got it. Okay.
Yeah.
Okay. So is there a ceiling like it's only up to 6% interest rate, or is there any ceiling like that, or any ceiling on the dollar
There's-
amount, or
Yeah, it's just the dollar amount, 750,000 up to the loan value of $750,000.
$750,000, and it's only on the interest rate?
Yes.
Got it. Thank you.
And you also get mortgage points in case you are purchasing the house. Initially, that can also be added.
Got it. Okay. What do you mean by mortgage points?
When you purchase a house in the first year, sometimes the banks give you the interest points.
Got it. Okay. Okay.
Another question. Karishma, you want to take this? Mega backdoor Roth.
How to convert Mega back to Roth 401k to Roth IRA without paying taxes on the conversion amount. This is something I'll have to research into. I don't remember from top of my head, but Hemant, if you can tell me who sent you this question, I'll probably reach out to them directly after doing the research.
Sorry. Yeah, this question was asked by Vineet.
Yeah, and I'm not sure about the.
Okay.
I see he has scheduled for he's filled up the form.
Yeah.
Okay.
So, folks, we have already received some good interest. So, I encourage, if you are looking to get personalized recommendations and advice, do use the form. Okay, let me put up the form again. Okay, Dinesh just put it.
Yeah, you guys can see the form now in the link. Yeah.
Yeah, we'll be sharing also the recording after this webinar. Make sure you have signed up using the Luma event. We'll be posting there once we have ready.
What is the event?
So this is the link where you probably got this Zoom link. I'll also share this in the community if you got the link from there.
Okay, I will.
Yeah, we cannot hear you, SK. I'll share this through the Luma and then the community also. So if you came from there, you will have the webinar recording.
And Hemant, one question I have is, do you also help with, I know we've been talking a lot about personal tax filing situations and all of that. Do you also help with business tax filing situations and planning for business, tax filings for the next 1 year, things like that?
Yes, we can help with that. Dinesh can share more. Yes, you
Yeah.
are.
Yes.
Dinesh has been extremely helpful for us this year. So
Yes, Manadeep, we can help you out to do the planning for the business also.
okay, thank you. I'll probably consult with you very soon.
Yeah, thanks.
And Dinesh, thank you so much for helping us this year. I know we were on a time crunch, but you were really, really helpful
Good,
despite that time crunch.
No, happy to help you.
And do also share with your friends or people in the network. So, I think this could be of benefit uh, to everyone in the US or every Indian immigrant in the US particularly, because what we are trying to achieve here is making smarter financial decisions to help you save on taxes or do better planning for your future. And we're going to be building more products and offering more solutions as we go in 2025 and even further. So do share about INRI and what we're doing about this webinar today, and also about the consultation. So if you are looking to get this done, I think this is the right time, and do reserve your spot, before we run out. Okay, so we do still have 10 minutes. Karishma, Dinesh, anything you want to share before we close? Any last pointers?
Nothing from my side. Just that if you have any questions, and if you could provide us with your 2024 tax return that you filed, that would help us uh, see if there are any planning opportunities available for you for 2025. And uh, planning usually happens right now. During tax filing, we can only look at how you could have planned better. And that's the reason we wanted to have this webinar right after tax filing so that we know the mistakes that were made. That or the deductions that were missed in the prior year, and also you would also realize based on the tax that you see currently, your tax form, on how you could have planned better. And this year, in the next 6 to 8 months, we could help you with that tax planning.
Yeah. So same thing. We are also trying to build tools in the backend. So we would love to talk to you, understand what solution would be ideal to you, and offer you that solution so that you not just save taxes, but also compound your wealth from the money that you save from taxes. Yeah. Thank you so much, everyone. And I think we can wrap up this call. Right,
Yeah,
Hemant?
thank you, everyone. It's really a
Thank you.
really great come. Thank you.
Have a
Thank
great
you.
weekend
Thank
to
you,
all of
everyone.
you.
Have a good weekend.
Thank you.
Thank you so much for this. Bye bye.
Thank you, Mahdeep.